Now let's head to Kenya, where banks are in talks with the government about changing a law that caps commercial interest rates as lending in East Africa's biggest economy slows. President Uhuru Kenyatta introduced caps on lending rates in August against the advice of the country's central bank and the Treasury, but it's failed to rejuvenate a private sector credit growth, which slowed to a 16-month low of about 4.3% in December from 18% a year earlier. Now, the International Monetary Fund warned this month that the retention of these rate caps could cut Kenya's economic growth rate by as much as 2 percentage points this year and, of course, next. Now, the caps have limited access to credit by small and medium-sized businesses as banks resort to less risky lending to the government. Well, let's get some more information on this. We're joined by Jared Osoro. He's a Director of Research and Policy at the Kenya Bankers Association. Welcome to the show, sir.
Thank you very much.
Now, as we mentioned there, the president did introduce this caps against the advice of the central bank, against the advice of the Treasury as well. So tell me, were these interest rate caps necessary? And certainly, what are the challenges that they've posed?
First of all, thank you very much for inviting us to this to have this conversation.
Sure.
I think the thinking behind the introduction of the capping of interest rate was that the interest rate regime in Kenya was basically high. We had seen a trend where the interest rates were coming down, but they are not coming as fast as many people expected. So the assumption, therefore, was that if you cap them, you will bring them down. There's a problem there. In the sense that the determination of interest rate has both market dynamics and structural dynamics.
Right.
So if you don't address the structural aspects and the market aspects, then controlling a price will not help. So as far as we are concerned, it was not necessary. What was absolutely necessary was to look at critically the structural aspects and the policy aspects that can bring the interest rate down sustainably.
Give me more insight into the structural aspects that you're talking about.
Now, we are looking at a number of things, including the way the industry operates from the competitive parameters, aspect to do with the credit evaluation, including introduction of aspects like credit information sharing that now will see customers being rewarded for the quality of credit that they have, and other aspects including, for instance, the extent to which the government comes to the market to borrow and therefore, in a way, influencing the pricing of credit. So what the capping does is that it jumps all those steps and goes into the price capping, and that's where we see it's not being necessary. Yeah.
But give me more insight into why Kenyan banks aren't lending. I mean, the government has pointed to the fact that smaller firms in Kenya cannot secure loans from local banks. They've also accused banks of charging excessive rates on smaller businesses. So why? Why aren't Kenyan banks lending?
I think that's a very interesting question because before the capping was introduced, Kenya was among the leading economies, actually the leading economy in Africa insofar as lending to small and medium enterprises is concerned. So it's interesting that, there is a feeling that the banks were charging very high to the small and medium enterprises. And it's also worth noticing that when it comes to small and medium enterprises, given their risk profile, the motivation for them is access to credit and not necessarily the cost of credit. Now, one of the aspects that the banking industry, and indeed all those that you mentioned that are opposed to the capping of interest rate mentioned, was that if you cap interest rates, it's going to lead to credit rationing to the same entities that you're trying to help by capping credit. Essentially, what capping does is introduces a tool which is meant to address the cost and then brings an aspect of limiting access.
Right.
So you try to address one problem and create another problem.
Right.
Yes.
Well, tell me about your talks that you're currently having with the government about changing the law. Is the government willing to budge so far? And certainly, are you targeting a revision of this law, or are you looking for the government to repeal it?
It's interesting you ask that question because the law has been in effect for slightly more than 1 quarter. The focus of the banking industry has mainly been implementing the law as is. Any talks that are going on are the usual talks, that the policy engagement that happens between the industry and the regulator and the government. So, and among the things, of course, is to see how quick this law can be reversed because we've started seeing early signs of it not working as envisaged. Yeah. So, what will be ideal is really repealing this law completely and not necessarily amending it. Because
do you think the government will budge?
Well, I don't want to second guess the government, but I think we've seen in other jurisdictions where such laws have been implemented, the effects have been disastrous, and therefore the government resort to repealing it. So that's what we'll hope. But even an accommodative amendment comes into effect that allows banks to price credit appropriately, to price risk appropriately. That will be welcome. But I think the optimal or the ideal really will be the amending of the law.
Right.
Yeah.
Now, going forward, the central bank says that we'll see this drop in private sector credit growth bottom out soon. Do you agree with that?
It depends on how they define soon, because we've seen the reduction in private sector credit coming down drastically for almost a year. So you cannot entirely attribute that to the interest rate capping, because the interest rate capping came towards the end of the year. Now, for one to focus that they will be bottoming out is simply making an assumption that one may not necessarily agree with. And that assumption is that credit is not linked to what's happening in the rest of the economy. The same central bank has reviewed downwards its growth forecast, just like the IMF has. So if there's a two-way relationship between what credit does and the economy's performance, then it would be interesting for the central bank to envisage credit to start expanding at a time when the economy is looking down. So I think I may not necessarily agree with such a kind of assessment.
Well, we'll certainly be watching. Many thanks for joining us in the studio.
Thank you very much.
Of course, that's Jared Osoro. He's the Director of Research and Policy with Kenya's Bankers Association.